Good afternoon, welcome to the Market Wrap for week ending 7th of May 2021. Stuart Williamson here at the helm. Okay, today we're going to talk about a report that's just come out from Capital Economics, a guy called Roger Bootle, who is their CEO or chairman or the like. So he's a very knowledgeable character. And basically his view is that UK residential property prices are going to fall in real terms. And let's just look at their background to this. Okay, at the moment, there is a great underpinning of the property market. There's some fantastic factors in place that are making it go very well. Nationwide last week talked about house prices continue to go up. I think they're up by about 6.8% for the year. And you might say, well, that's not surprising, is it really? Do house prices always go up? Well, not really, no. If you imagine, a year ago, it was the start of the worst recession we've had for 300 years. Everyone would have thought that house prices should have gone down. And most of the pundits were saying that, most of the knowledgeable people. 20% falls in prices, I think, was one of the quotes I saw. Okay, in fact, during the last 4 recessions in the UK, over the last 50 years, house prices have fallen in real terms. But not this time. House prices are up at a 6-year high. Okay, and the rationale is really not difficult to see. I mean, it's a case of you've got great government support, and they have done a very good job, including the furlough. Stamp duty holiday has pumped up demand, and then cuts in interest rates to new record lows and kept borrowing affordable. So there's some great factors there. But the average house price that we've got at the moment tells us something, okay? And basically what it tells us is the HPE ratio, which is the house price to average earnings ratio. And what that basically means is the last time we had this ratio was back in 2007, and after that house prices fell by nearly 20%. It suggests in the face of it, house prices are currently extremely expensive, and they're due to have a house price fall, which is what a lot of people are still saying to me. Okay, but the house price ratio, okay, isn't all of it. There's also basically the affordability ratio. And the affordability ratio is that, on average, the UK household will spend up to 25% of its income on a mortgage, and that's normally what it does. And so if you've got super low interest rates, and this is the common denominator between the house price average and the affordability ratio, is that previously we haven't had these super low interest rates. And that is what is underpinning the market to a large extent. Okay, so with these interest rates low, it enables people to have larger mortgages, and that pushes up house prices. But it's not for everyone. And this is where we've got generation rent coming into it, because it becomes less affordable for certain people. In fact, the quote is, I think, owner occupation has fallen from 70% in 2003 to 65% now among 25 to 34-year-olds. It's become even worse. It's down to 39%. So generation rent is just not happening for them because they can't afford to get on the housing ladder because of the affordability ratio, i.e. if houses are £100,000 and you're only earning £25,000, you can't borrow 4 times your earnings that easily if you're a first-time buyer. Whereas if you're experienced and you're a landlord or you're an older person, you can do that. So that's where you're getting a mismatch, and that's why generation rent is coming into play. So what we've got so far is a very strong market underpinned by, in reality, stimulus, low interest rates. However, we've got people being squeezed out of the market. Okay. Now, why, therefore, would it not crash fairly soon? Because when interest rates went down to 0.1% last year, the banks didn't pass all that on by any means. They pass a very small amount on. So there's a huge amount of availability there for interest rates to rise and the mortgage rates not rise at all. So that's one part to it. And then secondly, unemployment. You always thought unemployment was going to be a very bad thing and come back hugely. But it doesn't look as though it will. It will rise over the next year or so. But with the economy absolutely booming, we've got the roaring 20s. We've got apparently this week it's 200 billion in money that people have put aside and not spent. In addition, the UK public has paid off £500 million more of personal debt. So there's a lot of cash out there. So basically, when you've got mortgage rates that can won't go up that much, where you've got unemployment that's going to be pretty good, plus you've got heaps of cash out there. It should continue. But this is where the two big concerns in the marketplace are. One is supply. There is not enough property out there for people to buy. And so the government is trying to stimulus is help to buy, help to this, help to that. And that doesn't work, because all it really does is help a few people. Everyone's trying to get on the ladder, and it just pushes up prices more. And the second threat is the chance of interest rates rising. And if interest rates rise, that will cut off the supply of cheap money, which means that the market will fall. And so we will have a falling house price situation. And that is the potential problem we have on the horizon. And Roger Bootle from Capital Economics is saying, okay, we've got a lot of positive things out there, but at the same time, I think there's a big cloud on the horizon, and that's his view on it. And just to explain a bit more about that, basically what he's saying is that inflation isn't just food in the shops, it's wages as well. So wages go up, and as wages go up, it makes things keep up to speed and becomes more affordable again. Also, inflation will erode debt away. So what he then goes on to say is that although he thinks that house prices in real terms will fall, other things will improve, i.e. wages will become much higher, which makes houses more affordable. He then says that inflation will erode debt away. So the big debts that are taken out now will actually become quite small. And I think I've said this previously, the first house I bought in Hackney in 1986, the mortgage was £58,000, which is a king's ransom. Now it wouldn't buy you a really good car. So the point is that he believes that inflation, if it does come in, and he expects to see it over the next, probably post 2025 coming in, he believes it will then start to erode away what's going on as far as the big debt out there, all this cash that's been printed. And that in reality will actually help the property market. Although in real terms, the houses might not be worth as much as they are today, it means they won't fall, and it'll be set up well for a new upward movement. So in reality, it's a very positive outlook now. We're going to see some changes in that inflation is going to come in probably, and it will erode a lot of the debt away, but also a lot of the gains. But income will increase and allow us to buy a lot more. So his summary is, although the immediate outlook for the market seems fine, it's difficult to believe that current HPE ratio will be sustained over the medium term. Over the coming decade, real house prices are going to struggle, just as in the 1990s, and real house prices could fall potentially. But that's not the full picture, because what will be beneficial was that debt will be eroded away, income will go up, and people will be able to afford more houses with more money. So it's a very positive outlook for property again. And that's from Roger Bootle, Chairman of Capital Economics. I think I've interpreted it correctly. If I haven't, Mr. Bootle, I do apologise. Thank you very much. Good afternoon.